Hello, everybody, and welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way to exit your highly appreciated assets tax deferred so you can create, preserve, and grow your wealth. I'm your co-host, Pearson York, filling in for Brett Swarts, and each episode I'm joined by some of the best wealth, business, real estate, and leadership individuals in the world to share ideas, deal stories, and inspiration so together we can make complex tax deferral strategies simple and passive income plans achievable. As always, we're streaming on expertcresecrets.com. We're streaming on Capital Gains Tax Solutions YouTube channel, the Kingdom Luxury Realty YouTube channel, Kingdom Luxury Realty Facebook channel. And our next guest I'm very excited about has been in the wealth advisory space for well over 20 years. And he has an MBA from Harvard, undergraduate from Duke, has grown multiple businesses and consulted for many large corporations that we know today, and has since started his own firm with his friend at Tucker Bria, and has a wealth of knowledge and experience. So please, everybody, give a warm introduction to Jim Tucker. Jim, how are you doing, my friend?
Pierce, first, thanks so much for having me on today's show. I am doing great. We're here in what hopefully is the end of winter and the end of COVID, so all that's good.
Yeah, absolutely. Absolutely. So I gave just a brief, 2 to 3 of the multitudes of highlights on your resume over there. And I know I did no justice at all, but it was too long for me to read. It was like a phone book thick of all the accomplishments that you've done. So tell me a little bit about your backstory and how you got to where you are today.
Well, sure. It's a great story, but a train wreck to go through. What I would say initially is that I consider myself a lifetime admissions mistake. So I have an undergraduate degree from Duke University and an MBA from Harvard. So you've mentioned that, and then I've had experience in the commercial banking space, the investment banking space, the institutional real estate management space for a large institutional player for their general account, as well as for their separate account for their outside investors, as well as being part of startups in the mall-based specialty retail space with Natural Wonders a number of years ago, and then also with a more recent public company, Avid Exchange, out of Charlotte, North Carolina. So with that, in 2003, I decided to get off an airplane and start an entry into the wealth management arena. Did that first with the large Wall Street firms, a couple of them, and then in 2013 with my lifelong friend Pat Bria. We were both swimmers, both in Pittsburgh and at Duke University, and then we got together in 2013 to start Tucker Bria Wealth Strategies, and it's been nothing but positive events. Working with a great friend, as well as building a company and helping people, has been just fantastic since 2013.
Yeah, absolutely. Awesome. So plethora of experience. What are one or two strengths or spiritual gifts that you have that have led you to be as successful as you are?
Well, I think and thank you for the question. It's a great one. The strength that I feel I have, the superpower, is taking complex financial concepts and making them easily understood to my clients. And what is really important, what I always say when I'm introducing a concept to my clients, is that if you don't understand what I'm talking about, that's my fault. That's not your fault. And the best thing about this superpower is over the course of this podcast, all of your listeners will be able to figure out whether I actually do have that superpower or not, whether I can take a couple complex subjects that we're going to talk about and make them easily understandable.
Yeah, absolutely. So before the show, we were talking about some of these complex tax deferral concepts that you had just briefly mentioned to me. So let's just dive right into that. What are some phenomenal tax deferral strategies that you're using with your clients today?
Well, the best thing I'm going to provide your listeners and viewers with two actionable strategies that they can take with them and either use for their own personal experience or pass them along to family and friends. The two actionable items, the first is direct indexing, and the second is using your investment account as a collateral for a loan. So, direct indexing is where I'm ready to start. Any brief questions, or should I just dive right into it?
Yeah. So what is it? Let's start there.
Fantastic. Okay, what direct indexing is a way to invest in the S&P 500 and get some additional tax losses. So very simply, anytime I introduce a concept to clients, there has to be a value add or a problem that needs to be solved. So in the case of direct indexing, the problem that needs to be solved is over the last 10 years, and I'll use the S&P 500 as the example, there have been a great deal of gains across, whether it's just those five stocks everyone talks about on the technology space, but more generally, over the course of those 10 years, coming out of the financial meltdown of 2008, 2009, we've had a great run up in S&P 500. So what you have, at this point in time, hopefully, is a portfolio that you have some capital gains that you have to deal with. So you can sell them and a bunch of different strategies, to reduce capital gains. But how about if you had the ability to create tax losses even as you're growing your S&P 500 portfolio? And that's what direct indexing allows you to do.
So is it different than like a tax loss harvesting strategy or?
Well, it basically that's what it is. So let me sort of step back and give a brief history of where we've come as investors. We've started with mutual funds. Mutual funds are basically you pool your dollars with those of other investors, and then you have a manager who invests those dollars, and you get hopefully growth and returns from that. Now, what mutual funds require to have happen is what I call the December surprise. So you've done great tax planning over the course of the first 11 months, and then the mutual fund is required by law to distribute their capital gains and dividends by the end of the year. So you've done this great tax planning for 11 months, and then you have this December surprise where all of a sudden, hopefully, you only have a 1 to 3% capital gains event. But there have been times where those mutual funds have been in double digits, in 10, 13, and I've even seen 15% of NAV coming out as a December surprise. So mutual funds gave rise to Jack Bogle and the Vanguard strategy of, okay, let's do indexing. On the active passive, mutual funds, you have active managers. Index fund, basically S&P 500. You buy 500 stocks through an index, and then you just sit back and watch what happens, and hopefully everything goes up. And then when a company gets thrown out or enters the S&P 500, that's when you have a change. With that, you have great tax efficiency because you really don't have those December surprises. But you have the same issue that I just mentioned, that over the last 10 years, for example, that you have the S&P 500 growing very large. So you have this capital gains event. So let's, and the outgrowth from the index funds has been the exchange traded funds. Exchange traded funds have really just taken the indexing concept and grown beyond just the traditional indexes that we talk about. So you have things like a country fund or a sector fund, like a healthcare or technology fund, that you have maybe not an index that you can rely on, but you have a sector. So now that's all great. And now we have a situation where let's talk about investing in the S&P 500. So what I love about direct indexing is it's very comforting to talk to clients and say, hey, you're going to be invested in S&P 500 stocks. That's the first thing. It's not this complex strategy. So then what you have is a manager who doesn't buy the entire index, doesn't buy the 500 stocks. They ultimately look for within the sector to keep the sector balanced. So to have the right amount of energy exposure, the right amount of technology exposure, healthcare exposure, consumer discretionary, and what have you. And so what you then have is 125 to 200 stocks that you own. And that's the first piece and differentiation between going through a mutual fund or going through an index or ETF, where you as the investor are pooling your money with other investors. With direct indexing, with typically a requirement to have at least $100,000 into a separately managed account. So basically, you own the individual stocks in the portfolio. So that's the first piece to understand. You're buying the S&P 500. You own the 125 to 200 stocks that make up the subset of the S&P 500. What I love to say is that you have turned now an 8-page monthly report that you get from your brokerage firm into an 80-page report, because each of the individual 3 shares, 2.5 shares of Apple, of Microsoft, are now listed as opposed to one line of the Acme Mutual Fund. So that's the first piece. And that's fairly straightforward. You own own 125 to 200 S&P 500 quality stocks.
So let me pause you there
Sure.
real quick, just so I can make sure I understand. So basically, you're saying instead of buying into a mutual fund, you just cherry pick the best stocks out of the S&P 500 and you just buy those.
Right. Well, it's a manager who's doing this, so we're not doing it on our own. We could, but it's much easier to have a manager do that. So yes, so you have a manager that hopefully is cherry picking the best stocks within their sector, be it consumer discretionary, technology, energy.
So you basically get to break it up off of the different categories or energy sectors or healthcare sector or whatever. You get to cherry pick the best ones, and you're creating your own little like, not fun, but your own basically portfolio of stocks that you like the best, and you have a little bit more control over them, or the manager does.
Well, right. So the manager has control, and so now over the 10 years, let's hope that all 125 to 200 stocks have gone up. But in say 2015 or 17 or 19, as all boats are rising, there's probably 1 or 2 or 4 or 5 companies that have a restructuring going on, have some negative press. So the end of the month comes along, and their stock is actually down. So you've actually have a paper loss, an unrealized loss on that stock. And what the manager then does is the manager sells that stock that's gone down with the full intention of buying it back after 31 days and meeting the wash sale rules. And so you basically, that is direct indexing. You basically have a manager who's buying the S&P 500, which we're using for today. It also can work and is done through small cap and mid cap stocks as well. But you have a situation where you create losses, or the manager's creating losses over the course of the year, even if the S&P and your fund, as an example, goes up 5%, let's say, you might have created an equal percentage or so of tax losses, which then are available to use as you see fit. And I can go into a couple of ways that my clients then use the losses that are created.
Yeah, so let's dive into that. But just before, I want to make sure. So out of this group of stocks that the manager has cherry picked, a couple of them don't do so hot. We sell those, and then with the full intention of buying them back 30 days later. But we're realizing the loss. And so because of that, we're able to actually write it off against the rest of the gains that we've had, and kind of bringing down the gain on paper.
Well, right. So you create the tax loss, and you don't have this December surprise. So you don't have any requirement to distribute any type of gains over the course, any capital gains over the course of the year. And so you basically have created tax losses. And that's the next piece of, okay, what are we using these tax losses for?
So because it's not a mutual fund or an ETF or whatever, there is no requirement to have a 1099 basically thrown out at you saying, "Hey, you guys gained all this money." So you
That's
actually don't.
Yep,
Gotcha.
that's a December surprise. Yeah, those 1099s that come that everyone scratches their head is why did that happen?
Yeah.
That's by
So
law.
so the fact that it's not a mutual fund, it's basically cherry picked. You don't have the December surprise, and then now you get to basically do the tax loss harvesting on the few that aren't to offset a lot of the gains. Is how we're okay. So now, how do we leverage this to save a bunch of money on tax, and what do they do with the liquidity?
Right. Okay. So ideally, an S&P 500 fund is going to be part of your core portfolio. So you're not going to want to necessarily reduce or sell and take gain specifically from that S&P 500 direct indexing manager. But what you might have, and many of my clients have, are concentrated positions. Concentrated positions either through stock options. And I had an example of a client who has $600,000 of Cisco stock, and there might be a gifting strategy for grandparents. Certainly down here in North Carolina, a number of grandparent generation bought bank stocks, and these community bank stocks have become part of one of the major banking institutions, and from that you basically have a zero cost basis in those stocks, but a ton of gain. And if you need cash, what you do is, and I use the example of $100,000 account, but a lot of my clients, because it is such a core holding, an S&P 500 holding, there might be 700,000, $1 million, $2 million of these of this position held. So you get some meaningful tax losses over the course of a year or a couple years, and then you can, outside of the S&P 500 direct indexed portfolio, you then start selling some of your concentrated positions, and then are able to offset some of the gain, the realized gain, with the tax losses that have been generated by this direct indexing portfolio.
Gotcha. Interesting. Okay, so that's one strategy you use. You mentioned two actionable items. So what's the second one? And
The
do they
second one,
tie in together?
sure. So the second one, the challenge or the problem that we're trying to solve is we have a portfolio that has a lot of gains, and we just have found this great real estate that we want to buy, but we have a down payment, or we don't want a huge loan, a mortgage loan. Interest rates are going up right now, what have you. So how can we get access to our money without creating capital gains by selling our investments in our portfolio? So the way that we do that is by pledging or collateralizing the investment account that we then use and get a loan against the value of our stocks. Now, this is not like a margin loan. So a margin loan is specifically taken out so that you can invest more money back into the stock market. A collateralized loan is referred to as a non-purpose loan, meaning that it cannot be used for securities investments. But I've had a number of clients who have gone through this process and have created this line of credit that they can access, say, $1 million, for a down payment, or for a large portion of their real estate need, without selling and creating any capital gains on their portfolio. Typically, the loan to value rate is somewhere around 60 to 65%. And that being, it gives you some cushion. It operates, or can operate, in the same way that that a margin loan is. That there always can be the issue of a cash call. But we have a partnership with Goldman Sachs Private Bank at Tucker Bria, and through that, we just identify with the client how much they want to borrow. So let's just make it simple. Say they want to borrow $1 million. They might need 1.7 million of a portfolio. But let's say they have, and this also, by the way, has to be non-retirement assets. So it has to be a taxable account. That's the other requirement. It cannot be a tax-advantaged account.
So it can't be an IRA or a self-directed IRA or anything like that.
That's correct. That's correct. It needs to be a taxable account. But let's say you have a $5 million taxable account. Well, you don't need to pledge the whole thing. What I do on a regular basis is carve out a portfolio that or an account, create a second account that may only have that $1.7 million in it, that allows the additional, in my example, $3.3 million of that $5 million account to stay totally unencumbered by this collateralized loan. So very straightforward.
Yep.
What I like to do, and the benefit here is that my clients don't need to worry about taking their loan away from me as their financial advisor and putting it with the bank. That then has control a lot of times over the trading in that account. I'm free to trade the account that's been collateralized. I just can't, or I need to go through a process if I'm going to take money out of the account. So it's very simple. The other thing that is loved by all of my clients, and I'm sure your listeners will jump at this, there are 3 questions that need to be answered. You do not need to go back 5 years of your financial life and give them to a bank lending officer. They're basically 3 questions. Everything's done in the background between the asset custodian from Tucker Bria, which is NFS, and the Goldman Sachs back office, and then it's done. So the other great piece of this is that it's an evergreen loan. By that means you don't have a repayment schedule. All that you're required to pay off in any month is the interest. And the interest is set depending on the size of the loan. The loans can be for as little as $75,000. And it's basically a line of credit. It's not even a loan, because there are no fees associated with this. So it's not like you have a commitment fee that you're going to pay 1% to have this access to this line of credit. There are no commitment fees. You literally 3 questions, you have it set up. We have a number of clients who have this collateralized loan set up on their accounts, and they've never drawn on it. It's just there for, in today's real estate market, there's a lot of, hey, can I give you cash now? And how quickly can I get the cash? There's no requirement to have long lead times. Basically, it's money that's available to you for, again, real estate is the big use that I see with my clients on using it, especially in this type of market where having cash is king as you're in 20, 30, and 40 bid auction competition.
Of course. So you mentioned real estate a few times, and what's cool is that it sounds like you can basically just get everything squared away, so you have access to capital that you can just deploy on a moment's notice. But and until you do, you're not having to pay anything on having this capital basically ready to go.
That's right. There are no commitment fees. It's just there in the background and available. I did have a situation, unfortunately, that a client had a family member who had a health need, and it was a way to get to some significant dollars. I mean, you get a $60,000 medical bill. That's something that this client used that money and the loan, the line of credit for that medical situation.
Interesting. Okay, so you mentioned real estate a few times, and a lot of your clients are obviously probably interested into real estate. What's your biggest frustration with the capital gains tax and the 1031 exchange?
Oh, here's an interesting story. Thank you, Pierce, for bringing this up. I am a financial advisor who also is a real estate investor, and what I can share, and I do share all the times, a couple things with me is clients who have real estate who come to me as to be their financial advisor, because my first question isn't, gee, why don't you sell all your real estate and let me invest it? Because that's not how you make true wealth in our country. The way you make true wealth in our country is by having some real estate. And as long as you have the stomach the cash flow, and can handle, depending on the type of real estate you want to get involved in. So that's the first piece. The 1031 exchange is certainly out there, certainly available. As I entered the real estate investor market in 2008, 2009, I went to a friend, an acquaintance who had over 350 single family and multifamily units in his portfolio. I'm nowhere near there, nor do I have the capital or time to get there. But I asked him about, okay, give me the tax strategy that you use with all your portfolios, and how do you to use the 1031 to take one property and delay the capital gains. And he said, "What's 1031?" And what he shared with me was that as a real estate investor, from his perspective, when the depreciation goes away, he's more than happy to pay the ongoing tax on the property, because he knows the property. And he knows the property, and the issue of doing a 1031, again, it's just how you're wired. In the 1031 opportunity, again, I'm assuming all your listeners know what that is, but for those who may be joining us for the first time, who may not know, that's when you take a appreciated property, a real estate property, and you exchange it for another property. And by exchanging it and staying within the real estate universe, you delay the payment of the capital gains on that real estate property.
Yep.
So it 100% is a very valuable strategy for a number of individuals, real estate investors, who are wired to want to get those depreciation dollars and delay the tax man as it relates to when depreciation goes away, and you're really in a position where you have to start paying tax on that. The other strategy, which actually is the one that I'm now following, is from my friend, incredibly successful. He lasted in the emergency medicine field for, I think, 6 months, and then he became a real estate investor. His view is that it's not about the tax issue. It's about owning real estate and creating wealth for himself, his family, and now the greater good. So it really has been just a different way to look at real estate investing. Certainly, there's all this talk about 1031s, but your listeners, you don't have to go through the process of selling a property that you want, that you like. You also don't want to, obviously get an emotional attachment to any property. But from the standpoint of 1031s, absolutely a great strategy if you want to pursue that. But don't feel left out. There are at least two people on this earth, my friend and me, who aren't looking at the 1031 strategy. And we're more than happy when the time comes for the individual properties to get income and pay gain on that.
So basically, what it sounds like is your friend is a buy and hold, and he'll just
Right.
he'll hold forever, and that's one way to completely avoid the capital gains tax on is you just never sell it, and you just pay the ordinary income tax that comes in from the from the property once you've kind of just depleted the depreciation, and from there you just you've gotten your use out of it, and the rest of it is cash flow, and you'll pay the tax on what's left.
Absolutely, and that's exactly the other strategy, and it's more for everyone just to understand. There's not one correct strategy really for anything, but in the case of real estate, certainly the 1031 is a strategy that you have a lot of people with knowledge and expertise there, and then other who just say we're going to buy and hold. Certainly in this market, which is crazy, at least on the residential place.
Yeah, absolutely, and I mean we love 1031s. We love buy and holds. I mean, whatever, makes the most sense. Each individual has their own, unique situation and whatnot. But for those that are just tuning in for the first time, one of the things that that we do here at Capital Gains Tax Solutions is we actually can not only sell an asset and put it into any sort of other asset. It's with a 1031, you typically have to go back into, you sell real estate, you got to go back into real estate. But with our strategy, the Deferred Sales Trust, you actually don't have to go back into real estate. You can go back into any sort of investment period. So it can be stocks, it can be bonds, it can be Bitcoin, it can be business, it can be real estate, and you're not constricted with this time horizons. And then when you what you're talking about, Jim, and you basically will just eat the rest of the income tax,
right?
With the Deferred Sales Trust, you don't necessarily have to do that. You can sell the asset and transfer it into a new asset when the time is right. And on top of that, you will get a brand new depreciation schedule, unlike a 1031, which the schedule will travel with you. And so there are definitely multiple different strategies and whatnot. One of the questions I would pose to you is that at what point do you feel like once the property is depreciated and you're cash flowing, and you have to start sinking money into the property in order to maintain it, what do you do at that point?
Great question. As I'm renovating 2 bathrooms right now, so I don't know how you figured that one out, but good. Yeah, I mean that without question is why your strategy of being able to not only go into other real estate but also into other investment vehicles is another strategy, because what is necessary is that you really need to keep your properties up. I mean, I don't want to be a slum lord, and I don't think many people do. And so you really do need to have dollars that are available to put back into the property, either through equity or through some cash flowing from the existing properties. That's one of the challenges, at least here in North Carolina, that finding real estate that is cash flow positive, even as rents go through the roof, is very difficult. Which is why what I'm seeing a little bit more, whether you have a lot more people doing the flips to try and get the dollars out quickly, or you see these investment pools coming down from created through Wall Street, where they're buying a bunch of properties in different markets and then packaging them and selling them to retail investors. Those are always, again, from my perspective, not the pond I fish in. So I don't know the details around those and the success rate of them. But things that to your point, I mean, you have a specific product that is probably very attractive to a number of listeners and a number of real estate investors, because of the need to stay 2 steps ahead of the tax man, as well as the issue that you bring up is that it's a depreciating asset, not as bad as a car, for example, but you have to keep the property up. And if you're in the tenant landlord space that I'm in, that can be challenging at times.
Yeah, definitely. Cool. Well, Jim, I know that we're kind of getting low on time here, so I'm gonna bring you into the lightning round really quick, and then I will get you out of here. So, what is your favorite leadership quote?
The one that came into my mind is from General Stilwell, which is Latin "illegimati non carborundum," which is "don't let the people grind you down, and I'll let people decide what people means." But so don't let people grind you down.
Nice. Okay, what's your favorite book?
My favorite book is one I'm the recent book. I wouldn't say it's the favorite book, but one that was meaningful to me was the Tree of Life shooting in Pittsburgh, Pennsylvania, which I had the opportunity to read. I obviously had a lot of friends, family who were members of that horrific event with a gunman killing a number of worshipers. So that's something that not to be a downer, but something that was very meaningful to me.
Okay, great. And what are you most curious about right now?
Crypto.
Interesting.
Actually, it's something that as a financial investor, I am not permitted to make a recommendation on, but trying to figure out where and how it's going to fit into the overall money changing world that we live in. Yeah, I'm not a fan of the euro, but I see crypto having none of those issues. But again, beyond the scope of today's call.
Yeah, that's a whole nother podcast that
That's right.
we can deeply dive into. Cool. Well, Jim, thanks so much for coming on, and really appreciate your time. And where can people connect with you?
Well, the easiest way, our firm, Tucker Bria Wealth Strategies, and I also have a YouTube channel. The easiest way to access my YouTube channel, Creating Family Wealth, can be found through the link on our website. And it's really, we're here in Durham, North Carolina, but we have clients all over the country, including Alaska. So
Awesome.
it's a great business, and I love every second of it.
Awesome. And you guys can find out more about the capital gains tax solutions at our website, capitalgainstaxsolutions.com. We also have a weekly mastermind, 10 a.m. Pacific, 1 p.m. Eastern time every Friday. And that is a great place to come and ask questions, learn about the Deferred Sales Trust and all of the amazing benefits that it has, along with other phenomenal capital gains tax solutions. You guys can find all that at capitalgainstaxsolutions.com. You can check us out on YouTube, where we're streaming right now. Everybody, please rate, review, and subscribe. Jim, any parting words?
No, I just think that basically have your group of people who are your advisors, who your go-to people, like you and Brett, and then stick with it, and don't worry about what anyone else is telling you to do.
Awesome. Cool. All right. And thanks everybody for listening to another episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way to create, preserve, and grow your wealth. Guys, thanks again for listening, and we'll see you on the next one. Thanks again, Jim.